Welcome to this video from IFR for NPO, where we explain the proposals for inventories included in International Nonprofit Accounting Guidance, Exposure Draft 2, Section 13. This covers NPO-specific issues relating to recognition, measurement, presentation, and disclosure. It also includes donated items and inventory intended for use or distribution, rather than for sale. Our goal is to make the proposals accessible, to stimulate feedback from stakeholders. We encourage you to watch the video on donations in kind first, because it is related to this topic. You will find the link in the YouTube description. INPAG adopts the basic model for inventory accounting from the IFRS for SMEs accounting standard. In this model, inventories are initially recognized when received and measured at cost. When the carrying amount of inventories cannot be fully recovered, an impairment is recognized. Inventories are subsequently measured at the lower of cost and net realizable value. Net realizable value is the estimated selling price, less costs to complete and sell. Guidance is provided on determining the cost of inventory, covering the inclusion or exclusion of specific costs. It also covers the allocation of production overheads and permissible techniques for measuring cost. Where a cost formula is needed, two options are permitted: first in, first out, and the weighted average method. Expenses are recognized when inventories are sold, distributed to service recipients, or used by the NPO. At the same time, they are removed from the balance sheet. This basic model will be familiar to those involved in standard inventory accounting. INPAG Exposure Draft 2 proposes amendments to address NPO-specific circumstances. INPAG defines the assets that constitute inventories. It introduces two new asset categories, unique to NPOs: items for distribution to service recipients, and items used in fundraising activities, such as prizes. INPAG generally requires inventories to be recognized on receipt and measured at cost, like the basic model. However, acknowledging significant issues for NPOs, the guidance includes some adaptations and exceptions. These relate to donated inventory, work in progress, and measurement. INPAG Section 23, on revenue from grants and donations, includes exceptions for many donated items. In certain cases, NPOs are permitted to not recognize revenue, or to defer its recognition. If an NPO applies these exceptions, Section 13 requires parallel treatment, by prohibiting the recognition of inventory. The permitted exceptions cover three scenarios. Firstly, low-value items donated for resale, or as fundraising prizes. Revenue is recognized when the items are sold or fundraising activity takes place. Secondly, items donated for distribution to service recipients, or for the NPO's internal use. Recognition can be delayed until the items are distributed or used, rather than when they are received. The revenue and expense are recorded at the same time, to show the receipt of the donated item and its use. Note that this exception does not apply to high-value inventory items or non-current assets. The third permitted exception relates to services in kind, which is relevant when the services would be part of the cost of inventory items. As INPAG permits NPOs to not recognize revenue for services in kind that are not mission-critical, it follows that such services would not be recognized in valuing inventory. To illustrate, if volunteers design awareness-raising leaflets for an NPO, these costs would be part of the cost of producing the leaflet, and part of the value of that inventory. However, if the NPO chooses not to recognize revenue from the donated services, it logically follows that the value of these services would not be included in the inventory value. INPAG permits NPOs to expense work in progress on services that are being provided to service recipients for free, or for a nominal amount. For example, if an NPO provides legal services, and a particular case is part way through at the end of the financial reporting period, it can expense the costs it has incurred in progressing the legal case. Without this exemption, it would need to be treated as work in progress and included in inventories. This exception greatly simplifies the accounting, and is provided for cost-benefit reasons. The basic model values inventories at the lower of cost and selling price. However, where NPOs hold inventory for use or distribution, there is no selling price, so an alternative approach is needed. INPAG proposes that these inventories are measured at the lower of cost adjusted for any loss of service potential and replacement cost. This proposal is intended to enable NPOs to reliably measure all inventories in most circumstances. Service potential is an important concept introduced in Exposure Draft 1, INPAG Section 2. It acknowledges that an asset can have value to an NPO in contributing to its objectives, regardless of revenue generation. If an item of inventory is damaged, therefore reducing its service potential, then its value is impaired accordingly. Whenever donated inventory is initially recognized in the financial statements, it is measured at fair value. The definition of fair value comes from existing accounting standards. It is the amount that would be received or paid in an orderly transaction between market participants at the measurement date. Fair value can be a challenge in cases where there is no market, or where the value to the giver differs from the value to the receiver. INPAG Section 12 on fair value will be issued as part of Exposure Draft 3. It will remain largely unchanged from the source material in IFRS for SMEs, but some application guidance is proposed to address donations. The application guidance for inventories clarifies that the cost to the donor can be used as fair value if this is known. For NPOs holding multiple units of identical inventory items, it is necessary to use cost formulas. INPAG permits two cost formulas, first in first out, or the weighted average method. A third formula, first expired first out, was also considered, given that it could be more appropriate for NPOs receiving donations of perishable items, such as food or medical supplies. However, inventories of perishable items are not unique to NPOs, and an additional cost formula was not considered necessary. The basis for conclusions explains when such inventories could be treated as a separate class, without the need for a new cost formula. Moving to disclosures, INPAG proposes two additional requirements for cases where inventories are not recognized. Firstly, whenever NPOs use the permitted exceptions for not recognizing inventories, they must provide a description of the inventories impacted and an explanation of why the exception has been used. Secondly, in rare situations when inventories cannot be reliably measured, NPOs must provide a description of the donated inventories received. For example, a small NPO responding to an emergency may not have the time, systems, or resources to keep accurate records of the receipt and distribution of donated inventories. This video has outlined additional types of inventories that an NPO may need to record. It also sets out the permitted exceptions for the recognition of inventories, which largely mirror those in the section on revenue from donations in kind. Reliable measurement is made possible by the inclusion of a new measurement method for inventory held for use or distribution, and use of the concept of service potential. Disclosures are required where permitted exceptions have been used, and also for the rare circumstances where donated inventory cannot be reliably measured. We look forward to hearing your feedback on the proposals in Exposure Draft 2. The invitation to comment includes questions on the proposals explained in this video. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is March 15, 2024.